Hello viewers, in this video I will explain the concept of the accounting equation, also called the balance sheet equation, with a few simple examples so that even a novice may understand this concept. So please watch this video carefully. The accounting equation represents the relationship between the assets, liabilities and owner's equity of a person or business. It is the foundation for the double entry bookkeeping system. For each transaction, the total debits equal the total credits. The accounting equation can be expressed as assets is equal to liabilities plus equity. In a corporation, capital represents the stockholders' equity. Since every business transaction affects at least two of a company's accounts, the accounting equation will always be in balance, meaning the left side of its balance sheet should always equal the right side. Thus, the accounting formula essentially shows that what the firm owns, that is assets, has been purchased with equity or liabilities, that is with funds it has borrowed and therefore owes, that is its liabilities, plus funds invested by the founding shareholders, that is its shareholders' equity or capital. You also need to note that the profits earned by the company ultimately belong to its owners and they are added to the equity. I demonstrate the working of the accounting equation with a practical example. Suppose John opens a new business by depositing $1,000 into the business bank account. How this transaction will affect the accounting equation is shown on the screen. On the asset side, $1,000 is added to the business bank account, that is a type of current asset. Following the double entry bookkeeping principle, $1,000 is also added to the equity side because this $1,000 is the investment made by the owner in the business. Since the liabilities are zero, therefore, both sides are equal with a total of $1,000. Next day, he purchases $500 of inventory on credit. How this transaction will affect the accounting equation is shown on the screen. On the asset side, inventory of $500 is added, and on the liability side, $500 of accounts payable are added because the inventory is purchased on credit. You need to remember that inventory is a type of current asset, while accounts payable are a type of current liabilities. After this transaction, both sides of the equation are again equal. On the left-hand side, there are total assets of $1,500, and on the right-hand side, there are total liabilities and equity of $1,500. He sells 50% of inventory for $350 on credit. This transaction will affect both sides of the accounting equation as shown on the screen. On the asset side, there is a reduction of $250 from the inventory because 50% of the inventory is sold. Since it is a credit transaction, therefore accounts receivable, that is a type of current asset, has been created with a sales value of $350. If you notice, on the left-hand side of the accounting equation, 50% of inventory asset is converted into another asset, that is accounts receivable. On the right-hand side of the equation, a profit of $100 is added to equity, that is the difference between sales price of $350 of inventory and cost of sales of $250. After 1 week, he pays $500 to accounts payable. This transaction will reduce the accounts payable to zero and also reduce the bank balance by the same amount of $500, leaving the bank balance as $500. The other two assets, inventory and accounts receivable, will remain unaffected by this transaction. After a few days, he receives $350 from accounts receivable. This transaction will increase the bank balance by $350 and reduce the accounts receivable to zero. Consequently, the new bank balance will be $850 with the addition of $350 received from accounts receivable. This transaction will not affect the right-hand side of the accounting equation because the debits and credits have only impacted the asset side, implying that bank has been debited by $350, that is increase in asset, while the accounts receivable have been credited by $350, that is decrease in asset. In the next week, he sells his leftover inventory on cash for $400. This transaction will add $400 to the bank balance, a reduction in inventory to zero, and an addition to profit of $150, that is the difference between the sales price of $400 and cost of sales of $250. On the left hand side, inventory will disappear. The bank account will show a balance of $1,250, and on the right hand side, the profits will increase by $150, making the total profits as $250. The total of both sides will remain equal as $1,250. You need to keep in mind this fact that the accounting equation or the balance sheet equation demonstrates the mathematical relationship between the assets, liabilities, and equity of a business. If you have noticed, it also demonstrates that how individual transactions impact the balance sheet of a business. Interestingly, with each new transaction, a new balance sheet of the business is created. However, for practical and legal reasons, most businesses prefer to construct a balance sheet on an annual basis. If you have liked this video, please do subscribe to my channel for future updates. Also share and like this video. Thank you for watching.